Good morning, everybody, and welcome to our autumn statement analysis. Just a little bit of housekeeping before we get going. If you're unable to hear anything via computer, please see on screen now the login details via the telephone with the number and the access code that you'll need. Not that we should be well tuned to this, given this is our third one of the year, but if there is any technology issues, I apologize in advance. So a little bit about myself, for those that don't know, I'm one of the directors of tax here at Mitchell Charlesworth, predominantly specialising in corporate tax matters, but have a wide range of owner-managed business knowledge. I particularly work in group reorganisations, research and development tax relief, and mergers and acquisitions in the main. Please don't hesitate to ask any questions during the webinar via the chat function, and I will look to answer as many of those as I possibly can at the end of the webinar. If it's a particularly specific question, I will say that I'll get in touch with you directly post webinar, and you can always access and contact me directly as well. My details will be on screen at the end of the webinar. Please feel free to contact me. There's my email address. The session is being recorded and it will be circulated along with the slides following the webinar. And just one other little bit of housekeeping, if we can all make sure that we're on mute, that would be really appreciated. So here's what we're going to talk about today. Obviously, we were here about seven weeks ago doing a presentation on the mini budget, as it was called then. So we're just going to do a quick recap on what was previously announced and where we were going into this statement. And then we'll move on to what happened in the statement. So here we'll talk about the income tax changes that were announced, and the corporation tax rate and what that rate rise now means and how it will work in practice, and the changes to the R&D tax relief and how that impacts claims depending on the size of the business and the profitability or loss-making elements of the business. Just a recap really on the stamp duty threshold and the very minor change that was announced in the statement. Other matters that were announced, so surrounding capital gains tax, inheritance tax, and vehicle excise in particular, and any questions that you may well have after I've gone through these slides. So just a little bit of a recap. So the mini budget that we had back in September, the following information was announced and we went through last time. So we had the abolition of the additional rate tax and 1% reduction in the basic rate tax to 19%. The health and social care levy was scrapped, reduction in dividend tax rates by 1.25%, the scrapping of the planned corporation tax rise to 25%, relaxation of the IR35 rules, annual investment allowance to be maintained at £1 million per year, SDLT thresholds increased on purchase of residential properties, and creation of investment zones. And we were then left with now only the following three items are still in place. So the scrapping of the health and social care levy, that has gone through Parliament, and that was effective from the 6th of November for salaried individuals. Annual investment allowance has been maintained at £1 million, and this was backed up in the announcement and the statement provided last week. And the stamp duty land tax thresholds have stayed in place at a higher level, but with a slight change, which we'll go on to afterwards. So yes, massive economic turmoil that followed the mini budget and a big hole that needed to be plugged resulted obviously in a change of Prime Minister and Chancellor, and we're a major U-turn on the policy that has led to these announcements being made in the autumn statement. Obviously significant, a lot of what I said in terms of what may happen in the future has been obviously had to change, and plans are changing accordingly, and this was a massive change in emphasis and focus for a Conservative government moving forward. So the income tax and national insurance changes. So as well as the reversals that we just talked about then, there was then further changes announced in the autumn statement. So instead of the 45% rate being abolished, actually now it's going to be triggered on a lower level of income. So it's income over £125,140 rather than £150,000. It's a very specific number, that 125,140, but that's because of the personal allowance element to all this. So income between 100,000 and 125,140 pounds, you start to lose your personal allowance. For every £2 you go over, you lose £1 of your personal allowance. So once you've lost your personal allowance in this instance, you will be straight into the 45% rate of tax, rather than having another circa £25,000 of higher rate tax payable on that income. Basic rate of income tax, that's going to remain at 20% and is no longer dropping to 19%. Importantly, the dividend tax rates are going to remain the same. So the 8.75%, 33.75%, and 39.35% rates that are shown on screen now, they include the health and social care levy previously. It's important to note that that's now not being changed and not being reversed out. So we were going to go back to 7.5%, 32.5%, and 38.1%, but actually they're going to be maintained at their existing levels. And another important point on dividend allowance is that the dividend-free tax allowance, which currently stands at £2,000, that's going to reduce to £1,000 from April 2023, and then reduce again to £500 from April 2024. What has garnered a lot of press attention and in relation called stealth taxes, as it's been called, is the personal allowance and national insurance thresholds. They will now remain the same and fixed until 2028. So that's quite a long period now where the personal allowance of £12,570 and the national insurance thresholds that are currently in place, they are all going to remain at the same rate and not change for another nearly 5.5 years. And they call it a stealth tax because, as in theory wages increase and grow, people will pay more tax now in the future than they would have done if the personal allowance and the basic rate bands and national insurance thresholds had also increased in line with inflation as well. So what do all those changes actually mean ultimately? And we've got I've got two examples here. So the first example is just purely for salaried individuals. What does this actually mean? And a lot of the press attention has been on the fact that these announcements will cost families more over a period of time. But actually in the next tax year, so in the 2023-24 tax year, you'll see for the majority of individuals, they will have an increase in income in the next few years. So, for example, £30,000 there, that's an increase in income of £211, and that goes up, except for the individuals that are earning between 125,000 and 150,000 as a result of the reduced threshold for income tax on additional rate taxpayers. The reason it's an increase in income is because of the scrapping of the health and social care levy. So we're in a bit of a weird situation this year where we've got higher rates that were announced in July for national insurance. We then had the scrapping of the health and social care levy that came into place from the 6th of November. And then in the next tax year, we've got full allowances and no health and social care levy of 1.25%. So that does result ultimately in income increasing in this year based on those figures. As we say there, the difference between 125,000 and 150,000 is a drop in income, and that is because of this reduced threshold that we've got for the additional rate. But once you've gone over 150,000, if you already are over 150,000, for example, then you are again going to be earning more income after that. For dividends, it's a different picture. If you're on a standard salary, so £9,100 plus dividends package, income from dividends will drop across the board, up to £125,000. That's because of the reduction in the dividend allowance. So we've got that reduction by £1,000, hence the £88 reduction. And then we've also got, for after that, the fact that the thresholds for additional rate taxpayers has reduced as well. Important point to note there, though, is that although it's a reduction in income through dividends, it is still more tax beneficial to be done on a salary dividend basis because you have got more net income as a result of this strategy compared to pure salary. So those owner-managed businesses on the webinar, you're still on the right track rather than taking a salary. Moving on to corporation tax. So previously announced corporation tax rise to 25% will not be enacted. This was then reversed and has been scrapped, and therefore the rate rise to 25% on profits over £250,000 will now be implemented. Profits below £50,000 will be taxed at 19%. And then if profits are between 50,000 and 250,000, then they are taxed at a marginal rate of tax, with the effective rate rising as profits go higher. Important to note here that unlike with income tax, where you've got a first tranche at a certain percentage and then the next tranche at a higher rate and then the next tranche at an additional rate, that's not the case with corporation tax. So if your profits are £49,000, they'll be all taxed at 19%. If they are £251,000, they'll all be taxed at 25%. And if they're in between 50,000 and 250,000, for example, then they'll be taxed all at the effective rate rather than having a band at 19% and then the balance thereafter. There are some other mechanical changes almost to corporation tax, and in terms of determining how many companies are associated, which impacts the above thresholds as well. So we are at some what we'll call 51% group companies. We're going to move back to something called associated company rules. I'm not going to go into massive detail in the webinar on that, but this is something that myself and the team will be looking at for the clients and determining the position accordingly and advising on how that impacts you moving forward. So the effective rate on profits. Now, I could have gone into a lot of detail as to how this is calculated, something called marginal rate and marginal relief, and really gone into a lot of detail and bored a lot of you about this. But what I thought was probably easier is just to demonstrate what is the rate of corporation tax as you rise from a 50 grand profit to £250,000 profit. So we start off, obviously, £50,000, that's at 19%. And as you rise through the rate levels, you start to pay more corporation tax as you rise. So £60,000, that's 20.25%, 75,000 is 21.5%, 100,000 at 22.75%, 150 you hit 24%, 200 you're going to paying 24.63%, and finally you've hit 250,000 and you'll pay 25%. So it's a progressive increase in corporation tax rate as the profits continue to grow. As we said before, though, it's not a case of a band at 19% and then the balance thereafter at the effective rate. It's a case of if you're 150,000, for example, all the profits are taxed at 24%. Probably the biggest changes that were announced, or new announcements as such, in the autumn statement were surrounding R&D tax relief. And it's been widely reported in recent weeks. So we've had articles in the Times, we've had a Treasury subcommittee meeting on R&D tax relief as well. And without a shadow of a doubt, there is wide-scale abuse that goes on within the R&D tax relief scheme. And it's been particularly noticed in the SME scheme in particular by HMRC, who had a major clampdown on some quite significant fraud that was ongoing in the R&D relief scheme earlier this year. And government research has also indicated that companies that claim under the RDEC scheme, which is for in the main larger companies, but also for SMEs that claim other forms of state aid, they tend to reinvest more into more R&D activities than companies under the SME scheme. And this has led then to the following changes that were announced in the autumn statement and are effective from the 1st of April 2023. So the SME enhanced deduction for qualifying R&D costs, that's been reduced from 130% to 86%. So instead of getting an extra £1.30 for every £1 you spend on R&D, you'll get an extra 86p for every £1 you spend on R&D. The SME cash credit rate, that's reduced from 14.5% to 10%. And I'll explain a little bit more the impact of that in a couple of slides' time. But on the flip of that, the RDEC rate, which is currently at 13%, that will increase to 20% from April 2023. So how does that impact an R&D claim moving forward? And I've got 3 examples to show you. So the first example is of an SME profit-making company. And we're going to use an example of a £100,000 qualifying expenditure on R&D activities. And I'm going to assume across this example and the RDEC example as well, that the corporation tax rate we're paying at is 25%. So the actual 100 grand spend on R&D, that's already attracted 25 grand of corporation tax relief pre-R&D claim. That's in calculating what the profits are for the year. And then under the SME scheme, the 100 grand will provide an extra £86,000 of expenditure to reduce the profits by. Therefore, at 25%, that provides an additional £21,500 in corporation tax relief. So actually, when you combine the standard relief in inverted commas and the additional relief that we get, the total corporation tax relief from an R&D claim and R&D expenditure is £46,500, and that is an increase of £2,800 in comparison to the current rates. So actually, for profit-making SMEs that are reinvesting in R&D activities, the rate of relief is slightly higher than what you were previously obtaining. However, for loss-making SMEs, the changes really do hit quite hard. So we're going to use the same example as we had before. And when we're surrendering for the cash credit, we can exchange that for the lower of the total R&D spend for tax purposes, which in this instance £186,000, being the £100,000 actual spend plus the £86,000 additional deduction, and the taxable loss for a cash credit at 10% of the value. I'm going to assume that the lower figure in this scenario is this £186,000, and therefore at 10%, that provides a payable cash credit of £18,600. That's cash coming back in from HMRC. And ultimately, on the initial 100 grand spend, that equates to 18.6p back from HMRC for every £1 that's spent on R&D. However, when we compare that to the current rates, which is up to 33.35p back from HMRC for every £1 spent, that is a significant reduction of 14.75p for every £1 spent. Very, very significant change there. You're talking over nearly 50% reduction in amount that can be received back from HMRC. I'm going to surmise that that's probably because they feel that's where most of the fraudulent activities are undertaken. But ultimately, it really does hit hard on startup tech companies, for example, legitimate startups who are undertaking legitimate R&D that no longer have that significant support from the tax system. In comparison, the ARD example, it makes for much better reading. So just as a side here before I delve in, RDEC is mainly claimed by larger companies, and large companies for this purpose are defined as over 100 million euros turnover, over 500 staff, and over 86 million euros net assets. Two of those three criteria to be met. It also applies to SMEs that obtain other forms of state aid funding. So be it, for example, an Innovate grant or other UK state funding, they have to then claim under the RDEC scheme as well. And from the 1st of April 2023, this official RDEC rate will become 20%. But the way that the RDEC rules work is actually the credit that you calculate is taxed at 25% in this instance. So the actual net benefit of any claim is 15p for every £1 spent on R&D, as opposed to 20p for every £1 spent. So again, we'll use a £100,000 example. A company spends 100 grand on R&D activities, and this generates a 20 grand credit that's going to be brought in as income into the accounts and subject to corporation tax. So therefore, the net either tax reduction or cash repayment from an RDEC claim would be £15,000 in this example. This could also be offset against other tax liabilities. So, for example, outstanding VAT or pay as you earn, it would get offset against that before being paid out to the company. In comparison to current rules, under this example, the company would have got £10,530 back from HMRC. So that's an increase of £4,470, quite a significant increase. I think it raises the question as well for SMEs in particular. I think in the past, I know I've spoken to SMEs that have thought, should we get a little bit of grant funding, state aid funding to help us with the R&D project? And I've outlined how actually that has a significant impact on your future R&D claims, because instead of being able to get something at up to 33.35% in tax relief, you're restricting yourself to 10.53% in tax relief. A very big differential. Whereas now the difference is a difference of 18.6% under the SME scheme or 15% under the RDEC scheme. It's not as significant anymore, and I think it brings into focus that some some sort of state aid funding may well benefit upfront costs for the SMEs, as well as not having that much of a difference on future R&D claims as well. Stamp duty land tax. So in the mini budget, the thresholds for the residential properties were changed again, and there's been a lot of changes over the last few years, as during the pandemic in particular, over these thresholds. But in the autumn statement, it was announced that the changes announced in the mini budget would still be in place, but only until March 2025, and that's the change as a result in this statement. Previously, it was indefinitely, they weren't going to change, but now there's been a cap put on that of March 2025, and we haven't been told at this point what it will be after that. The hope with these changes is to stimulate the property market and provide a bit of long-term stability. And these changes were that the threshold for paying stamp duty land tax has increased to £250,000 for standard home movers. And the threshold for first-time buyers has also increased to £425,000, with properties up to £625,000 qualifying for this higher threshold. Important to note that the 3% additional charge and rates for commercial properties have remained unchanged. And another important point, which was asked in the last webinar about this, is that the increased threshold will apply to buy-to-lets, but you will pay 3% on that first £250,000 as opposed to 0% for a standard home mover. So, for example, this is a stamp duty charge for standard home movers. This is an example from HMRC themselves, and it just shows the difference from when it was originally announced on the 22nd of September 2022 and where we are now on the 23rd of September 2022, or now even as well. So 22nd September, you would have paid £1,500 on a £200,000 property purchase. That's now naught as a standard home mover, and you wouldn't have paid any regardless as a first-time buyer. For £400,000 property purchase, you would have paid £10,000 as a standard home mover. Now it would be £7,500. So that's a saving of £2,500. For first-time buyers, you would have paid £5,000, and now you're going to pay nothing. So that's a big saving of £5,000 there. For £600,000, the savings remains the same. It's still the same, £2,500. But for first-time buyers, that's a significant £11,250 saving. So you can see how it can try and stimulate the economy in that respect, in terms of providing that saving that therefore allows for investment into the home and other items potentially as well. Obviously, the current climate makes it particularly difficult for certain, particularly first-time buyers, to be spending £600,000 on a first-time home, for example. But the intention you can see there and why it was brought in. Just some other announcements to go through as well. So the first one's on capital gains tax. So there was widespread reports prior to the autumn statement that there could be a lot more sweeping changes on capital gains tax. And we get this chat a lot, and this chat tends to happen each time there's a budget or a statement. But it seemed to gather a lot more attention this time than it has done for the last 6 months or so. In the end, the changes weren't significant, I would say, and it only focused in around the annual exemption allowance. So currently, your first £12,300 worth of gains in a tax year are tax-free. That's free from capital gains tax. However, from April 2023, that will reduce to £6,000, and from April 2024, that will reduce to £3,000. So you're talking there of if you're selling a business, for example, that is a £6,300 difference in gain, taxed at for potentially 10%. So you're talking £630. If it's taxed at 20%, you're talking £1,260. And that difference goes up when we go down to £3,000 as well. So it's not as significant as it could have been. But it will have an impact on future capital gains that are incurred after the 5th of April 2023. Inheritance tax nil rate threshold, that's also been frozen to March 2028, as has for example, the income tax and the national insurance thresholds. So that will be at £325,000 for the nil rate threshold and £175,000 for the residential nil rate threshold. Big changes in regards to electric vehicles announced. So currently electric vehicles don't pay road tax. They are exempt from that, but that's going to change from April 2025, so that electric vehicles will become liable to road tax as well. There was other announcements around the benefit in kind position in regards to this as well, but we'll provide more information as we get towards that date. At the minute, the rates and the bands have been detailed for the next couple of tax years, and will then be announced further from April 2025 onwards. Lots of talk about windfall taxes in the statement as well. We've got an increase to the energy profits levy to 35% from 1st of January 2023 and extended to March 2028. So that's in place for the big oil and gas companies moving forwards. And there's going to be a continuation of reform to business rates. There's not a lot of information announced on that at this stage, but the statement indicates that it's going to provide an additional £13.6 billion in support over a 5-year period. Once we get more information on that, we will provide it to you, of course. And finally, for individuals, extension of the energy support from April 2023 with the cap increase to £3,000. So it's not going to be as beneficial, the support, as it is currently, but that support is extended to households. There was no announcement surrounding any extension to energy support for businesses. I think we'll probably hear more about that in March. We should have a budget in March 2023, and that should possibly provide more details to what they're going to do there, if they're going to do anything at all. So just to summarise, obviously massive upheaval in the world of politics and finance in the last few months, and obviously this statement shows a significant change in approach from a Rishi Sunak government compared to a Liz Truss government. The freezing of the income tax thresholds, that generates significant future tax revenues, and that is known as a stale tax, as I mentioned before, because as wages rise, the tax bands stay where they are, so people end up paying more tax than they would have done if the bands are raised in line with the wages increasing as well. So that's what we define as a stealth tax. But actually, in reality, at this stage, next year, as we've demonstrated in the presentation today, most earners will be better off on a salary position. Dividend earners will be slightly worse off, but overall still receiving a higher net income than if they were on a salary. In the R&D reforms, this is hopefully going to start a significant process of clamping down on the fraudulent activities within the scheme and allow for the relief to be maintained moving forwards. I think it's really important that this relief stays there. It helps businesses who are investing in R&D continue to do that. And I think hopefully by cracking down on the activities that we've seen in the marketplace, that this will help with that moving forwards. The downside to all this is that SME startup firms that can rely upon the relief to help grow their businesses are the ones that can be severely impacted by the changes in the relief. And hopefully they might see the light on this front and make some changes possibly in the future. I'm surmising at this stage. I don't know if they will or they won't, obviously, but it is impacting those companies that need it most, those legitimate companies that need it most. So hopefully this package that's been announced now plugs the gap in the fiscal funds, this £60 billion that was a gap that was being reported. Would I be surprised if more is needed in the next budget? Possibly not. I think if they're going to, particularly with a election probably planned for back end of 2024, if they're going to do anything else that's going to be tax rising and not beneficial, then it's going to be in the next budget to then try and plan ahead for the next general election. So that's everything that I was going to go through today. If anybody has got any questions, I believe there hasn't been any that have come through so far, but I'll just double check the chat and see. Nothing as of yet. I'll just give it one more minute just to see if anybody would like to. Obviously, my details are on screen now, so you are able to just drop me a message if you so wish, or speak to your engagement partner or anybody else you deal with within Mitchell Charlesworth with any questions. More than happy to come back to you separately if you shall wish. just one point just to re-emphasize for myself is that difference in salary dividends. Obviously, looking at the slides, it would look like should we be considering going back onto salary? But when you look at the net income position, it really is still more beneficial to be on a dividend from a net income rather than a salary position, where you're obviously the owner manager of the business. So again, it's one of those that can get asked quite often once we have changes. Is it still beneficial for me to be on this position? Absolutely, at this stage, it still is, and will continue to be for the foreseeable future. Okay, so I think we'll end the webinar there. But thank you very much for everybody that's attended. I hope you've all found it useful. As I say, if you would like to get in touch with me separately, please feel free to do so. My email address is on screen. You can find my details on the website as well. And I look forward to speaking to you probably next year now rather than for a fourth time this year. But thank you very much.